What's up, America? Welcome back to the channel. And folks, today we need to have a serious conversation about your portfolio. Look at this guy. July 2025. Portfolio down 30%. Life savings evaporating faster than your New Year's resolutions. Dividend income? Gone. Safe stocks? What's safe stocks? This poor soul is probably refreshing his brokerage app more than his Instagram feed, wondering where it all went wrong. But this guy, July 2027, portfolio up 150%, $150,000 safe his account, dividend income flowing like a money printer, sleeping peacefully with 6 rock-solid stocks. So what's the difference between crying guy and happy guy? Was it luck? Was it insider trading? Did he sell his soul to Jerome Powell? No. The difference, my friends, is that while crying guy was busy following the buy high, sell low strategy taught at the prestigious University of FOMO, happy guy discovered something Wall Street doesn't want you to know about. You see, there exists a secret society of stocks. We call them the Dividend Kings. Companies so bulletproof, so cash generative, that they've been paying an increasing dividend for decades. We're talking about stocks that have survived the dot-com crash, the 2008 financial crisis, COVID, and probably will survive the zombie apocalypse. These aren't your typical meme stocks that go to the moon one day and to the Earth's core the next. These are the Warren Buffett approved, grandma would be proud kind of investments that actually let you sleep at night instead of checking futures at 3 a.m. like some sort of financial insomniac. And here's the thing. While everyone else is playing casino roulette with their retirement funds, chasing the next GameStop, or try to time the market with the precision of a drunk dart thrower, you could be building real wealth with companies that have been printing money since before TikTok was even a thought. So if you want to be happy guy in 2027 instead of crying guy, if you want your portfolio to look like a rocket ship instead of the Titanic, then stick around, because we're about to reveal the 6 dividend kings that could save your financial future. Ready? If yes, let's meet our first dividend king, Johnson & Johnson. Johnson & Johnson is a diversified healthcare giant operating across pharmaceuticals, medical technology, and consumer health products. Here's what makes them a true dividend king. They've been increasing their dividend for 62 consecutive years straight. The current dividend yield sits around 3.2% with a payout ratio of about 65%. But they're not just maintaining the status quo. J&J is aggressively expanding. They just invested $55 billion in U.S. manufacturing over the next 4 years, acquired intracellular therapies, and they're making billion-dollar moves to broaden their medical technology reach. And here's what Wall Street doesn't want you to realize. While your neighbor Chad is buying random crypto coins named after dogs, J&J is literally in the business of keeping people alive and healthy. And last I checked, people aren't planning to stop getting sick anytime soon. It's like having a business model that's recession-proof, pandemic-proof, and zombie apocalypse-proof. The numbers don't lie, folks. This company has powered through every recession, market crash, and economic crisis since the 1960s. We're talking about a 135-year-old company that's been making money since before your great-great-grandfather was even born. When the next market crash comes, and trust me, it will come because the market has more mood swings than a teenager, would you rather own shares in Dogecoin 2.0 Elon Musk approved, or the company that makes the medicines keeping half of America alive? Stock number 2 is Procter & Gamble, and this one has an absolutely insane dividend track record. P&G has been paying dividends for 135 consecutive years, since its incorporation in 1890, and has increased its dividend for 69 consecutive years. We're talking about a consumer staples powerhouse with a current dividend yield of 2.5% and a payout ratio of about 60%. This is recession-resistant at its core. People don't stop buying toothpaste, shampoo, and laundry detergent just because the economy gets shaky. The company owns some of the world's strongest brands: Tide, Crest, Gillette, Pampers, and Charmin. These aren't just products. They're household necessities with incredible brand loyalty and pricing power. Here's the thing about P&G. While everyone's trying to predict the next big AI disruption, this company is quietly dominating your bathroom cabinet and laundry room. You literally can't escape their products. Wake up, brush your teeth, that's Crest. Take a shower, probably Head and Shoulders. Do laundry, hello Tide. It's like they got a monopoly on basic human hygiene. But let's talk about the challenges because I'm not here to sugarcoat anything. P&G faces some headwinds, tariff risks, consumer demand pressure, and it's currently trading at premium valuations. The company has been impacted by ongoing tariff uncertainties, and nobody knows exactly how that's going to play out. Here's how you should think about this stock. Short term, next 6 to 12 months, the restructuring and tariff impacts create uncertainty. You might want to hold for dividend stability, but avoid heavy new purchases until we see how their cost savings and price increases work out. Long term, 3 to 5 years, if P&G successfully executes its digital transformation and maintains brand leadership, its cash flow, low volatility, and dividend growth make this extremely attractive for conservative, income-focused portfolios. I'm not saying P&G is going to make you rich overnight. This isn't a rocket ship to the moon. But when markets get volatile and everyone's portfolio is doing the financial equivalent of a roller coaster, P&G is a steady, reliable friend who shows up with dividend payments like clockwork. Now, stock number 3 is where things get really interesting, because this next pick is Warren Buffett's absolute favorite stock and generates more passive income than most people's entire salary. Stick with me here, because after we cover this dividend machine, I'm going to show you a tech giant that's quietly dominating AI and cloud computing while paying you to own it, and then a payments company that literally makes money every time you swipe your card. But first, Coca-Cola. Buffett's investment in Coca-Cola currently generates $2.2 million in dividend income per day for Berkshire Hathaway. That's $93,000 per hour, $1,500 per minute, or $25.87 every single second. While you've been listening to this sentence, Warren just made about $100 from Coca-Cola dividends. Current dividend yield, 3%. Dividend increases, 63 consecutive years. Payout ratio, 75%. With over 500 brands in 200-plus countries, this is global brand dominance at its finest. And here's the thing about Coca-Cola. While Silicon Valley is busy trying to disrupt everything from transportation to space travel, Coke has quietly figured out how to make people pay $3 for 30 cents worth of sugar water, and somehow we all keep buying it. That's not disruption. That's straight-up wizardry. But let's be honest, Warren bought this decades ago when it was cheap. Today, you're paying fair value for a reliable dividend machine. This isn't a growth rocket ship. It's a steady income generator for conservative portfolios. Who should buy? Income-focused investors seeking stability and brand strength. Who shouldn't? Anyone hunting for explosive growth or worried about ESG concerns. Our next stock literally profits every single time someone makes a purchase anywhere in the world. The dividend growth potential on this one will make your head spin. Enter Visa. Visa makes money every single time someone swipes a card anywhere in the world. Current stats: 0.7% dividend yield, 16 years of consecutive increases, and here's the beautiful part: only a 20% payout ratio, meaning massive room for dividend growth. If you had invested just $10,000 in Visa back in 2020, that investment would be worth approximately $18,000 today in 2025. That is an 80% return in 5 years while collecting dividends the entire time. Most people's savings accounts didn't even keep up with inflation during that same period. Every coffee purchase, every online order, every business transaction, Visa gets a tiny cut of all of it. They're literally skimming pennies off the entire global economy. The pros: durable double-digit growth, hefty capital returns, and they dominate digital payments. The cons: sensitive to economic cycles and premium valuation. But Visa's chart tells the whole story. It's basically up and to the right for decades. A low payout ratio means your dividends could explode as they grow. Stock number 5 on our list is Berkshire Hathaway. Here's why Berkshire made it to our list. Instead of paying dividends, they reinvest profits into high-quality assets. It's like owning a diversified fund run by the world's greatest investor with ultra-conservative management. The track record speaks for itself. Berkshire has consistently beaten the S&P 500 over virtually every long-term period. We're talking about 20-plus years of market-crushing performance. And here's the beautiful irony. While everyone's panicking about what happens when Warren Buffett retires, guess what? That's happening at the end of this year. But instead of running away, smart money is doubling down. Why? Because Berkshire isn't just Warren anymore. It's a machine built to compound wealth for decades. Berkshire doesn't pay traditional dividends, but it creates wealth through appreciation and smart capital allocation. It's one of the most stable, reliable wealth-building vehicles ever created. The last stock on our list is simultaneously the safest tech stock you can own and one of the biggest money makers in my personal portfolio. Enter Microsoft, ticker MSFT. Microsoft offers something incredibly rare in 2025. Dominance in cloud computing and AI with sustained double-digit revenue growth, plus the safety of a dividend-paying blue chip. Current dividend yield is 0.67% with 23 years of consecutive increases and a payout ratio of just 21.9%, which means massive room for growth. Here's what makes Microsoft special. They're uniquely positioned in enterprise digital transformation, AI adoption, and cloud expansion. We're talking about Azure growing at 30% plus annually, Office 365 subscriptions that businesses literally cannot function without, and now they're leading the AI infrastructure race. While everyone's worried about tech being overvalued, Microsoft is basically collecting rent from every business on the planet. Every company needs cloud services. Every office worker needs Microsoft Office. And now every business wants AI integration. It's like owning a highway that every car has to drive on. The financials are rock solid. $200+ billion in annual revenue, over $80 billion in cash flow, and they're returning massive amounts to shareholders through both dividends and share buybacks. The payout ratio of 21% means they could triple their dividend tomorrow if they wanted to. Now, is Microsoft cheap? Absolutely not. As one analyst perfectly put it, Microsoft is a fortress with momentum, but you're buying the penthouse, not the fixer-upper. You're paying premium prices for premium quality. But here's why it's still worth it. When markets crash, and they will, Microsoft doesn't disappear. Businesses don't suddenly stop needing email, cloud storage, or productivity software. This is recession-resistant revenue with massive growth potential. Microsoft represents the perfect blend of safety and growth. There you have it. The 6 dividend kings that could transform your portfolio from disaster to dynasty. Which one caught your attention? Let me know in the comments. If you love this video, you might love these 2 as well. Consider watching them, and I'll see you there